Good evening and welcome back to Be Rich. Today I want to talk about Howard Marks. Howard Marks is one of the most remarkable men I have come across. In fact, I came across him in a very late stage in my life. I was almost in my late 40s when I first met him. That is, I have not met him in person. I came across him and I started reading his work. The first book I read of him was the most important thing, that was Risk. And he is the person who explained to me what is the risk. And till that point of time, I was confused with lot of arguments about what is risk and can risk be measured. He clearly explained in his books that risk is always there. His argument was any asset is risky if the price is too high, and any asset is less risky if the price is too low. So it is the job of an active investor to judge what is the appropriate price to pay for an asset and how much one should put his bet on it. In fact, he drew an X and Y axis and a straight line where the intersection of the X and Y axis was the starting point, where he said US Treasury bonds have no risk, and started with zero and kept on going at higher levels at how much risks till he reached junk bonds. That graph stayed with me for life. The other thing which I pointed out, he told me, beware of a 6-foot man trying to cross a pond of a 5 feet average depth but drowning to death. You'll be surprised. You felt that the average depth of the pond is only 5 feet. The man is 6 feet tall. How is it possible that he could sink in that pond? Well, the averages are deceptive. The pond could start with 2 feet, move down to 8 feet in depth, and again come back to 2 feet in depth. And if he did not know how to swim, he would have sunk at the 8 feet point. This is the point that Howard Marks was going to say, that risk is an iceberg where only a small portion is on the top. Most of the things are in the bottom and unseen. And like Titanic hit an iceberg thinking it's not big, finally sank. So this is how risks have to be measured. He said risk is nothing but loss of capital, because loss of capital is permanent. If I buy a stock for 100 rupees and the price drops to 80 rupees, then I have lost 20 rupees permanently. So this is why, according to him, Warren Buffett famously said the most important rule in investing is never lose capital. And then he said rule number 2, always refer to rule number 1. So all this volatility index and measurement of risk is bumkum. All Howard Marks said is, if your deal loses capital, then if your deal loses capital, it is risky. If your deal does not lose capital, then it is less risky. So the cheaper you buy the asset, the less risky it is. If you come across an intrinsic value for an asset and buy it far cheaper than that, then the chances of you losing your capital are minimal. If you pay a price way above the intrinsic level, the chances of losing capital are extremely high. This is what he said. Recently, he wrote a memo called Insight. This was a repeat of a memo that he wrote many years ago, being Dare to Great. He says very correctly that in the stock markets or any markets, the total sum is zero. That for me to gain some money, somebody has to lose money. I have been advocating a purchase of Tata Steel between 200 to 600 rupees. It went up to 1,350 rupees. I told people to sell at that point. It did not. Those who sold made a money. Some, like me, decided to hold on for a longer period because I thought I can hold the capital and wait for a longer term when the stock will return about 2,350. So this person who sold it to me at 250 has lost money. The person who sold it at 1,350 has gained money, that if he buys it back today at a lower price of 940, then the difference between them would be his profit. So for me to make money, somebody has to lose money. This is what he says. So over a period of time, what is the correct price to sell is very difficult to fathom, because there are billions of investors across the place. So investors tend to take average results. And if you want average results. You are satisfied with average results. You need not read. You need not invest your time. You need not think much about investing. All you have to do is buy a basket of assets and you will get the average results that are there in the market. You may not get extraordinary results, but you will not have major losses also. Most people are satisfied with this. If you are going to get average results, then you need not take extraordinary risks. Neither will you beat the average return when you take a call, nor will you fall way below the average. This is where most of the asset managers fall. It is the person who leans against the wind and takes a risk and takes a call against the concerns, a contrarian call, who can get two things. If his contrarian call turns out to be right, then he will get above average results and he would have beaten the index of the asset class against which he is competing. If he takes a call which goes wrong, then he would be getting a below average result. The sum of this argument is, if you want to produce above average results over a long period of time, you should be willing to stomach below average period for some amount of time. Otherwise, if you are not willing to accept below average results, you are not going to get results which are above average. Thank you for watching. Be rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.